So a mixed quarter for Simon Property Group, the retail real estate giant ticker SPG they just reported, and we're looking at a pretty noticeable divergence. They beat consensus on the top line, with revenue hitting $1.79 billion.
Right, that's a really solid jump from the 1.50 billion they did a year ago.
Yeah, exactly. But they missed on the bottom line. GAAP EPS came in at 1.49, and the street was looking for, 1.61 or 1.62.
Yeah, a pretty wide miss on paper.
Right. But here is the crazy part. Despite that 12-cent miss, management actually raised their full year 2026 real estate FFO guidance. They bumped it up to a range of 13.20 to 13.30 per share.
Which is, that's an 8-cent increase at the midpoint. You don't usually see that alongside an earnings base.
Exactly. And the stock reaction, completely muted. It traded slightly down right after the report, dropping about 1% to close at 220.55. So it's continuing this really mild retreat from that late July 52-week high of 238.50.
Yeah, and that's exactly what we need to unpack in this deep dive. Because we are looking at a really dense stack of sources today. We've got the Q2 earnings release, the supplementary data, management's call transcripts, and like a dozen analyst notes trying to make sense of this.
Right, because there's a huge contradiction here.
Totally. The mission for us today is to figure out why a company that is posting, frankly, record-breaking ground-level mall traffic is just getting kind of ignored by the broader equity market.
Yeah, or punished even.
Exactly. We need to see if their underlying real estate engine can actually outrun what is a notoriously brutal macro environment right now.
So let's start with that first friction point, right? That EPS miss. If you just pull up a standard stock screener and you see a 1.49 EPS against a 1.61 expectation, that looks like a massive red flag.
Oh yeah, for a tech company, that's a disaster.
Right. Or a consumer goods brand. A 12-cent miss would trigger a massive sell-off right at the opening bell. But here, like we said, the stock barely flinched. The market just completely shrugged off the GAAP earnings.
Well, the market shrugged because, and I think a lot of retail investors get tripped up on this, looking at GAAP earnings per share for real estate investment trust is just looking through entirely the wrong lens.
Yeah, you've got to use FFO.
Exactly. Funds from operations. That's the operative metric here. That's what the institutional market actually trades on.
Yeah.
The whole disconnect comes down to how standard accounting rules handle physical property.
Right, the depreciation.
Right. GAAP requires companies to depreciate their real estate assets over time. So the accounting model treats, a premier shopping mall the exact same way it treats factory equipment or a fleet of delivery trucks.
Like it's just losing value every single year until it's worth zero.
Exactly. It assumes it degrades.
But the reality of commercial real estate, especially Class A properties like Simon owns, is the exact opposite. Assuming you actually maintain the property, prime real estate generally appreciates in value over a long time horizon. Or, at the very least, it holds its value.
And that right there is where the GAAP EPS number just completely detaches from the actual business. Because those heavy depreciation charges are recorded as expenses on the income statement.
Right, so it artificially drags down the bottom line.
Exactly. It creates this phantom expense that completely distorts the actual real-world cash being generated by the business. So FFO funds from operations, it strips out that depreciation noise. It adds those non-cash charges back into the equation.
So you can see the actual cash-generating power of the portfolio.
Precisely.
I like to put a framework around this for people. It's like judging a REIT by its GAAP EPS is essentially like judging a high-performance sports car by its accounting depreciation schedule rather than its horsepower.
Oh, that's a great way to look at it.
Right. Like you might be aggressively writing off the car's value on your corporate tax returns to show a loss, but that has absolutely nothing to do with the fact that the engine is still pushing you from 0 to 60 in 3 seconds.
Yeah, taking that analogy a step further, the institutional investors, they aren't looking at the tax return. They are looking under the hood at the engine.
And what did that engine look like this quarter?
Oh, it's generating serious torque.
Yeah.
If you look at Simon's real estate FSO this quarter, it actually grew by 7.9% year over year.
Wow.
Yeah, hitting 3.29 per diluted share.
Okay, so nearly an 8% jump in pure operational cash flow. That is a massive signal of strength.
Right, and that 3.29 FFO is the number the analysts actually care about. It's the exact reason the stock only drifted down 1% instead of just cratering on the headline EPS miss.
So if FFO is the true engine, we really need to look at what is actually fueling that 7.9% growth. Because, I mean, the prevailing narrative out there in the broader capital markets is terrible for physical retail.
Oh, totally.
Like if you just drive past a dead suburban strip mall, you think physical retail is structurally broken. E-commerce won, physical stores lost, and malls are just, a relic of the 1990s.
Yeah, the mall is dead narrative.
Exactly.
Hmm.
But the physical property level metrics in this specific earnings report tell a completely different story.
They really do. There's this massive divergence between the macro pessimism surrounding general retail and the ground level reality of Simon's specific portfolio.
Because we're talking about Class A assets, right?
Right, the absolute highest tier malls and premium outlets. And the first metric that absolutely proves this is the occupancy rate. Across their U.S. portfolio, occupancy is holding rock steady at 96.0%.
Which we should really contextualize that 96% figure. Because in commercial real estate, 96% doesn't mean, oh, there are a few empty units nobody wants. It effectively means the properties are entirely full.
Yeah, complete max out.
Right, because you always have a natural structural turnover rate of around 3 or 4% anyway, just from tenants upgrading their spaces or undergoing renovations or just normal lease expirations where a new brand is rotating in.
Exactly. So at 96%, if a retailer wants prime space in a Simon mall right now, they are literally joining a waiting list.
And waiting lists generate pricing power.
Huge pricing power. Space is artificially constrained by that high demand, so Simon can dictate the terms. And we see that flow directly into their rent metrics. Their base minimum rent per square foot expanded by 6.3% year over year.
Wow.
Yeah, reaching 62.42.
Okay, 62.42 a square foot is a steep premium. Let me play devil's advocate and push back on this strategy, though.
Sure.
If a landlord is pushing base rents up by 6.3% in a single year, the immediate concern I have is whether they're just, squeezing their existing tenants to manufacture short-term growth.
Right, squeezing the golden goose.
Exactly. You can only raise prices so much before the underlying retailer's profit margin just collapses and they break their lease. So does the data actually prove that the tenants are thriving enough to absorb a $62 a square foot rent burden?
That is the primary risk anytime you see aggressive rent hikes. But the tenant sales data in this report completely invalidates that concern. Retailer sales per square foot, they didn't just inch up. They surged 13.9% year over year.
Wait, really? Almost 14%.
Yeah, they hit a record $838 for the trailing 12 months. So the tenants aren't just surviving the rent hikes, Their top-line revenue is radically outpacing their real estate costs.
Man, an $838 per square foot sales average just completely shatters the mall is dead narrative. But I do have to ask, how much of that 13.9% jump is just driven by inflation?
That's a fair question.
Because if the price of a pair of sneakers goes up 10%, the retailer's sales revenue goes up, obviously, but doesn't necessarily mean more people are actually walking through the doors, right?
Right. And inflation is certainly a component of top-line retail revenue, but it does not account for a nearly 14% surge on its own, especially as broader inflation metrics have actually started to cool down recently.
True. Did management say anything about foot traffic?
They did. Management, now led by CEO Eli Simon, following that leadership transition earlier this year, they addressed this directly on the earnings call. They explicitly cited broad-based leasing demand alongside accelerated traffic increases.
Okay, so it really is physical footfall.
Exactly. It isn't just price inflation. Consumers are actually returning to premier experiential shopping destinations in higher numbers.
And that's massive for Simon because of how their leases are structured, right? Because many of Simon's leases include percentage rent clauses.
Yeah, where the landlord takes a cut of the retailer's gross sales above a certain threshold.
Exactly. So Simon is directly participating in that 13.9% upside. The operational leverage there is just incredible. The tenants sell more goods, Simon collects more percentage rent, and the properties remain fully occupied.
And that flows straight into the cash generation. The data shows domestic property net operating income, or NOI, was up 8.5% year over year.
Which is fantastic, but if a company is throwing off that much operational cash, the immediate question for any analyst is capital allocation.
Oh, 100%.
Because companies with booming NOI, they often destroy shareholder value by making these poorly timed, overpriced acquisitions. Like they get too much cash and they just buy something stupid. So where is Simon actually deploying this capital?
Well, they're channeling it aggressively back to the shareholders, and they're utilizing two different levers to do it. First, the board raised the quarterly common dividend to 2.25 per share for the third quarter.
Okay, nice.
Yeah, that represents a 4.7% increase year over year. And for retail investors who look at REITs strictly as yield vehicles, a growing dividend that is backed by an 8.5% increase in net operating income is exactly what you want to see. The payout is fully covered by the cash flow.
Yeah, a 2.25 quarterly dividend is a very tangible return. But for me, the share repurchases are where the execution gets really interesting this quarter.
Oh, absolutely.
Because during the second quarter, they went into the open market and bought back roughly 1 million shares in partnership units. To break that down for you, it was 793,077 common shares and 237,618 limited partnership units. They deployed $211.4 million of capital to execute this.
Right. And the crucial variable in any buyback program, obviously, is the price at which the company acquires its own stock.
Yeah, buying back shares at the absolute top of the market is just pure value destruction.
Exactly. But Simon executed this $211 million repurchase at an average price of 205.10.
Wow. Which looks incredibly disciplined when you consider the stock is currently trading north of 220, even after the little post-earnings dip.
Yeah, they were very precise.
They didn't just blindly authorize a buyback and hit the market bid, They opportunistically stepped in when the stock dipped down to 205, which effectively signals to the market that their internal models value the real estate portfolio significantly higher than what the public market is currently pricing it at.
Right. It acts as a synthetic floor on the stock price while simultaneously increasing the equity value for the remaining shareholders. And they have the dry powder to execute maneuvers like this because their balance sheet liquidity is practically a fortress right now.
How much liquidity are they sitting on?
They're sitting on a massive $9.3 billion in total liquidity.
Wow.
Yeah. It's comprised of $1.7 billion in actual cash on hand and $7.6 billion in available capacity on their revolving credit facilities.
Okay, I am going to stop you right there because this is where the bullish narrative kind of hits a brick wall.
I knew you were going to bring this up.
I have to. $9.3 billion in liquidity sounds like an impenetrable fortress, right? But if they are printing cash, raising dividends, and sitting on a $9 billion war chest, why is their debt profile so incredibly aggressive? We have to look at the macro headwinds to keep this analysis objective, because the balance sheet metrics tell a story of significant leverage.
They do. The capital structure is the fundamental anchor dragging on this stock right now. Simon's debt-to-equity ratio currently sits at a highly elevated 4.68.
So for every single dollar of equity value, they are carrying almost $4.70 of debt.
Yeah.
And look, operating with leverage is standard operating procedure for a REIT. Real estate is inherently capital intensive. You use debt to acquire assets, and you use the tenant rent to service the debt. We all know that. But 4.68 is pushing into highly aggressive territory.
It is. But I'd argue the leverage itself isn't even the primary issue. The real issue is the liquidity mismatch when you look at their current liabilities. Right. Their current ratio is sitting at 0.84.
Oof.
Yeah. Think of a current ratio in terms of like a monthly household budget. For every dollar of short-term bills and debt obligations due right now, Simon only has 84 cents in liquid short-term assets on hand to pay them.
So they operate in a negative working capital position.
Precisely.
Which means they have to constantly rely on the velocity of their incoming rent checks, or they have to dip into those revolving credit facilities you mentioned just to bridge the gap and pay off maturing short-term debt.
Exactly. And bridging that gap requires borrowing new money in today's economic environment. Which brings us to the absolute core of the war thesis on this stock, the higher for longer interest rate cycle.
Right.
Because even with premier Class A assets, even with a 96% occupancy rate, and even with record tenant sales of $838 a square foot, carrying a 4.68 debt-to-equity ratio, while long-term treasury yields remain elevated, puts immense structural pressure on the valuation.
Because when their legacy low-interest debt finally matures, they have to refinance it at today's much higher interest rates.
Exactly, and that immediately increases their interest expense, which eats directly into that beautiful net operating income we just spent 10 minutes talking about.
It's like owning the absolute most popular restaurant in town, You have lines wrapped around the block, you've raised your menu prices, and the cash register is ringing nonstop. The fundamental business operation is flawless, but your commercial mortgage rate just doubled.
Right.
The restaurant is booming, but the bank is suddenly taking a massive bite out of your upside.
That is the perfect analogy. The real estate operations and the capital structure are basically fighting a war against each other. And you really need to understand who's actually driving the price action of this stock to see why it hasn't moved higher.
Who's buying and selling?
Institutional ownership of Simon Property Group is heavily concentrated at 93.01%.
Wow, 93%. So retail investors have virtually no influence over the stock's momentum. You are entirely captive to how the big funds model the macro environment.
Entirely. Furthermore, the stock carries a beta of 1.29, meaning it trades with significantly more volatility than the broader S&P 500.
And why does that matter specifically for a REIT?
It matters because institutional funds use algorithmic models that are heavily tied to the 10-year Treasury yield. When bond yields spike, these algorithms often just automatically sell off highly leveraged REITs because they view them as less attractive yield proxies.
Ah, I see.
Yeah, the institutions are trading this stock based on yield curve projections and refinancing models. They're often completely ignoring whether the mall tenants are generating $838 a square foot. The macro math just temporarily overrides the micro real estate fundamentals.
Which creates an incredible tension for anyone analyzing the company. You have this brilliantly performing portfolio of premier properties generating record tenant sales and massive cash flow, but it's just weighed down by the gravity of a highly leveraged balance sheet in a punishingly high interest rate environment.
Yeah. And this tension is exactly why management raising the full-year FFO guidance to 13.20 to 13.30 is such a confident signal.
Because they know the debt is there.
Exactly. Management sees the refinancing cliff. They know exactly what their interest expense will be.
Right.
But by raising guidance, they are looking at their internal leasing pipeline and their percentage rent upside, and they are essentially telling the market that the underlying properties are performing so exceptionally well that they can actually outgrow the macro headwinds.
The operational growth is actually outpacing the rising cost of debt.
That's the bet they are making, yes.
That brings us to a final forward-looking thought to leave you with today. We just spent this deep dive unpacking how Simon Property Group achieved record retailer sales, maintained functional full occupancy at 96%, and raised their cash flow guidance, all while fighting against a brutal high interest rate environment and an institutional market that views physical retail with extreme skepticism.
Right.
So you've got to consider this. If this is the kind of cash-generating engine they can build while driving directly into hurricane-force macro headwinds,
So,
what kind of explosive FFO runway will they have if and when the cost of capital finally normalizes?
that is the multi-billion-dollar question.
It really is. Be sure to hit the follow button on your app to get our daily earnings coverage, where we cut through the noise and tell you exactly what the numbers mean for your portfolio. Thanks for joining us on this deep dive.